More on these stories now. Let's cross to London, where we are joined by Arise business analyst Bode Ososami. Bode, bright and early on Monday. Quite a tough weekend that we have coming through. How do we go? Let's look at the markets responding to the situation in Israel and the Gaza Strip. What's the latest on the oil markets? What's left in the barrel of oil? Talk to me. Good morning.
Good morning, boss, and thanks for having me on the show. Well, our thoughts definitely are with families of those that lost their lives, and I understand over 100 hostages have been taken, over 1,000 dead. So clearly it must be a very harrowing period in that region. But as far as markets are concerned, the pattern tends to be an initial shock and risk aversion before the panic settles, depending on what the new status quo in the region is likely to be. I spoke to our chief correspondent, John Cookson, who is closely following developments. I believe he's in Israel as we speak. He thinks the situation is not likely to escalate to a regional crisis based on what he sees for now, because the Palestinians in the West Bank and Hezbollah have not fully, I think the key word is fully joined in with Hamas. Although Wall Street Journal is saying Hezbollah and Iran were much involved. If Hamas is not extensively supported by regional allies, if you've been watching Al Jazeera, you will see that there are calls for regional allies to rally around Hamas. They will be defeated like before, and Israel will be able to restore the status quo. But unfortunately, the reprisal attacks means many casualties also, as Israel demands unconditional release of the over 100 or so hostages said to be taken. So, like I said, the initial shock reaction is going to be a flight to safety. That's panic. That means gold and haven currencies are doing well, at least today. Dollars and yen are seeing gains. And there is demand for U.S. treasuries also seen as safe. U.S. defense and oil stocks, of course, will see tailwinds. Oil prices go up as tensions rev up. This is a region which accounts for around a third of the world's crude. Also, the resulting broader risk-off mood. We have a risk-off mood now. It's going to sour sentiment, as we've seen in European markets. So it's no surprise that European markets are opening today pretty much on the back foot. FTSE, however, managed to be positive 0.3, and that's because FTSE is very commodity heavy. So they benefit from those high oil prices. But international air carriers suspending their flight services to Tel Aviv, awaiting safer conditions. Airline stocks also are down, even as they see higher fuel costs. Like I said, the commodity-heavy FTSE 100 will be helped by high oil prices, but shares if you look at European defense companies such as Sweden's SAAB, Italy's Leonardo, and Rheinmetall, they're in the aerospace and defense business. Their shares are up 5.43%. If you look at Sweden's SAAB, their shares are up 8.73%. If you look at Leonardo, that's Italy's also the defense business, their shares are up 5.26%. Lufthansa is down 2.86%. IAG, that's British Airways, also down 3.97%. Of course, the likes of Shell are benefiting from this, up 2.73% on the London Stock Exchange. But on oil, let me just quickly mention that traders are definitely watching how the conflict affects oil production and transportation in the Middle East. Brent crude, as we speak, is actually about $87.38. So it's moving pretty close to 90. But if you factor in a risk premium, a geopolitical premium of about $5 to $10, depending on how this thing develops, it's not enough to take Brent to $100 in my view, and the geopolitical premium could fade fairly quickly if the situation is quickly brought to a normalcy, which is I doubt will be. But if we do get any retaliation against Iran, that could endanger the passage of vessels through the Strait of Hormuz. So there's quite a bit to deal with. Also in Israel, the central bank said that they're selling up to $30 billion in foreign exchange to support the shekel. They're also introducing about 50 billion in swap mechanisms to provide liquidity to the market. Today, of course, we begin the US Q3 earnings reporting season. That's something to also watch. Tech companies in Israel could face some disruption. Israel is the tech sector accounts for 14% of jobs and almost a fifth of GDP. So that's what worth looking at. But having noted all the possibilities, let me conclude by saying the number one risk for the global economy has to be the possibility of a third inflation wave, just as the current one is petering out. The flaring of tensions in the Middle East could drive energy prices up, and of course, this will undermine the efforts of central banks to bring inflation under control. So this has to be a very sensitive situation, and we're watching to see how it moves on an hour-by-hour basis.
Yes, a very tense situation indeed. And of course, as you mentioned earlier, hundreds of folks whose lives are lost and those who's been forcefully taken or taken hostage. But of course, it's a developing situation. We'll get back to the oil market story in just a while. Let's touch on with where you are with the Bank of England already talking to big banks on rescuing UK's Metro Bank. What's the latest here? Are we back to some of these issues of what happened just a couple of months ago in the US?
Well, Metro Bank, as you know, we actually discussed it late last week when it was discovered that they really need some help as far as their balance sheet is concerned, and they actually approached the PRA, that's Prudential Regulation Authority, in terms of some forbearance on their capital adequacy computations. Their shares went down, I think, on Thursday by 30%, but today the shares are going up about 20.82% as we speak, and that's because they were able to raise £925 million in debt financing and equity financing. There's a 150 million of new equity, 175 million of debt, and 325 million in a capital raise, 600 million in debt refinancing. So it's I think that's a lot of money to bring into your balance sheet, almost £1 billion. And they also agreed in principle with the PRA in terms of their capital situation, even though the PRA, that's the Bank of England, had also been trying to approach some of the other big banks to see if anybody was interested in taking on Metro. I understand NatWest Group, Lloyds Bank, HSBC, JP Morgan were all approached about a possible deal. But the bottom line is that if you look at who's now in charge, Colombian billionaire James Gilinski Bakal, he led the 150 million equity raise with his investment vehicle, Spaldi Investments. Spaldi, already Metro's largest investor, will now grow its stake from 9.2% to 53%. Some of the holders of bonds will have to take a haircut, a 40% reduction in the difference between the current market value and the value ascribed for purposes of calculating loan collateral. But I think good news is that Metro is out of its worst situation, up 22.65% as we speak. But I suspect this is, again, another situation we just have to keep monitoring. Fitch had commented that their earnings are under pressure, their balance sheet also is seeing a lot of strain, and this may be enough to give it some space, but it may not be enough in the medium to long term to keep it out of being snatched or swallowed up by one of these bigger banks who have the appetite and the cash to do so.
Also, we'll come back to the OPEC story over the weekend, a role to play in the energy transition. Can we trust OPEC Plus, drilling oil, fossil fuel, or dirty energy here, and talking about clean energy here?
Well, you can't trust them as far as energy transition is concerned, obviously. But the way to bridge the gap in trust is by involvement and by participation. OPEC heavyweights on Sunday at the United Nations Middle East and North Africa Climate Week, they said what they had repeated many times before, actually, that oil and gas should not be stigmatized in the climate debate. And the industry had a role to play in an orderly energy transition. UAE Energy Minister Suhail Al-Mazri, speaking on behalf of Saudi Arabia, the UAE, and Iraq, said they are major hydrocarbon producers, and they should also have a major responsibility to the world to provide a transition with enough hydrocarbon resources to make sure that the transition is orderly. OPEC, justifiably, in fairness to them, they see the premature disincentivization of fossil fuel investments to accelerate the transition without regard for analytics of supply of alternative energy sources. They see that as unhelpful to stability. My take is that OPEC should be part of the decision and not seen as the enemy. There is a win-win that can be reached by allowing alternative paths and propositions to be discussed as the goal to cut carbon emission is agreed. You saw the same thing from Rishi Sunak, was it 2 weeks or so ago. Also, notably over the weekend, Kenyan President William Ruto and the President of the African Development Bank, Akinwumi Adesina, and Musa Faki Mahamat, Chairman of the African Union Commission, and Patrick Verkooijen, CEO of the Rotterdam-based Global Center on Adaptation, said in an opinion piece that without a 10 to 20-year moratorium on interest payments on foreign debt, the world's poorest continent won't be able to cope with financial implications of climate change. They won't have the fiscal space to support the companies or to subsidize the process. And as such, they just won't be able to move. And they need definitely some support. So we'll see whether anyone is listening.
We'll see if anyone is listening. Thank you so much, Bode. Let's take a breather here. We're back with you later in the day. Thank you so much, Bode Ososami, out of London, Arise Business Analyst. You're watching the Global Business Report here on Arise News.